For beginners, investing can feel overwhelming. There are countless investment options and a lot of unfamiliar terms. Things like, what does ETF stand for? Should you use a market order or a limit order? It can all feel like a foreign language at first. That's exactly why I made this introductory video, covering everything you need to know to start investing this year. By the end of this video, you'll have the knowledge to make your very first investment and the confidence to keep investing for the rest of your life. Let me be brutally honest with you. If you're young right now and not investing, it's probably not because you're lazy. It's because no one ever explained it properly. Everyone says invest early, but no one tells you what to actually do. And today, I'm fixing that. My name is Blessing Ibrahim. I'm a multi-talented freelancer, entrepreneur, YouTuber, and career coach dedicated to helping individuals build profitable skills and purposeful careers. I remember being in my early 20s, scrolling through social media. One person was yelling, buy stocks. Another was saying, wait for the crash. Someone else was flexing crypto gains. Meanwhile, I was just thinking, bro, where do I even start? If that's you right now, this video is for you. Here's the scary part. Doing nothing with your money is still a decision, and it's usually the worst one. We'll cover why we invest, how to invest, what to invest in, and a few beginner strategies. Let's jump right in. Why should we invest? There are two main reasons to invest your money. First, inflation. If your money is sitting in a regular checking account, it's slowly losing value. The US Federal Reserve targets an inflation rate of about 2 to 3% per year, and you can feel this in everyday life. For example, a Chipotle burrito that cost me $8.50 6 years ago now costs closer to $12. If you had $50,000 in 2019, you could buy about 5,882 burritos back then. But today, that same $50,000 would only buy about 4,166 burritos, 1,700 fewer burritos because of inflation. In other words, your money buys less over time unless it's growing. That's why investing is so important. It helps your money at least keep up with inflation. If your money isn't growing, it's shrinking. Historically, the stock market has returned about 8 to 10% per year over long periods. By investing, you give your money a chance to grow faster than inflation. Second, compound interest. You've probably heard the phrase, it takes money to make money. Compound interest explains why. If you invest $1,000 and earn a 10% annual return, that's $100 in the first year. In year 2, you earn 10% on $1,100 and your balance grows to $1,210. If you keep this up for 20 years, that original $1,000 grows to about $6,727. Now imagine investing $1 million instead. At 10%, that's $100,000 per year, earned simply by letting your money work. The more money you have invested, the more powerful compounding becomes. I once met two co-workers. One started investing at 22, the other started at 32. The second one invested more money. Guess who ended up richer? The one who started earlier. Compound interest rewards time, not intelligence. Starting small, starting early, beats starting big, starting late. So where should young people actually invest? Not crypto hype, not lottery stocks, something boring but powerful. Why focus on stocks? Every time the market crashes, people panic, but zoom out and the market keeps climbing. Despite wars, recessions, and pandemics, stocks represent real businesses. Businesses adapt, businesses grow, businesses survive. The stock market rewards patience, not predictions. There are many ways to invest: real estate, gold, collectibles, and more. In this video, we are focusing on stocks, which are shares of ownership in public companies, for 3 key reasons. 1. Accessibility. Anyone can invest in stocks with an online account. 2. Liquidity. Stocks can be bought and sold quickly. 3. Predictable long-term returns. Historically, the stock market trends upward over time. For example, selling a house can take weeks or months. Selling a stock can take seconds. The S&P 500, which represents the top 500 companies in the US, has historically grown about 8 to 10% per year. While there are ups and downs along the way, the long-term trend has been upward. If you invested just $100 in the S&P 500 in 1980, it would be worth over $17,000 today. Even after adjusting for inflation, that's still an increase of about 44 times. That's the power of long-term investing. How do you start investing? To invest, you need an investment account, similar to a bank account but designed specifically for buying investments. There are two main types. Retirement account, like a 401k or IRA in the US. Regular brokerage accounts. Retirement accounts offer tax advantages, but your money is typically locked up until retirement. Some people like that forced savings, others prefer flexibility. Brokerage accounts give you full access to your money but require you to pay taxes on gains when you sell. Today, you can open an online brokerage account with companies like Fidelity, Charles Schwab, or Robinhood. No phone calls or brokers required. What should you invest in? You can invest in individual stocks like Apple or Tesla, but this requires more research and comes with more risk. That's why many financial advisors recommend index funds and ETFs. These investments are diversified, low cost, and simple. An index fund tracks a group of stocks like the S&P 500. Instead of picking winners, you invest in the entire market. This gives you instant diversification and very low fees. ETFs, exchange traded funds, work similarly and trade like stocks. You will recognize investments by their ticker symbols, which work like airport codes. For example, Microsoft MSFT, Tesla TSLR. By consistently investing in an S&P 500 ETF over decades, even $500 per month, you dramatically increase your chances of becoming a millionaire. When should you invest? The best time to invest is as soon as you can. Many people hesitate because the market feels too high. But the S&P 500 trades at all-time highs about 8% of the time, and new highs often lead to more highs. Missing just a few of the market's best days can drastically reduce your long-term returns. That's why consistency matters more than timing. As financial writer Nick Majuli puts it, just keep buying. Even if you invest when the market is expensive, long-term holding dramatically improves your odds of success. How much should you invest? What matters most isn't how much you invest, but how consistently you invest. If you are just starting out and don't yet have stable income, investing in yourself and your skills may come first. Once you have consistent income, even small monthly investments can add up over time. Understand yourself as an investor. Your strategy should match your risk tolerance, time horizon, financial goals. Younger investors can usually afford more risk because they have time to recover from downturns. Older investors often shift towards safer investments as retirement approaches. Investing always involves risk. Some years will be great, some will be flat, and others will be negative. But historically, long-term investors have been rewarded. If you are young and starting today, 1. Open an investment account. 2. Buy a low-cost index fund. 3. Invest consistently. 4. Ignore noise. 5. Let time do the work. You don't need to be an expert, you just need to start. If this video made investing clearer, share it with a friend who's still confused.